In our last video, we saw that as you add more assets to the portfolio, that you're still going to have a hyperbola in mean variance space. And in fact, even if you add all the assets in the world into the portfolio, and when you think about it, that's a lot of assets, okay? But we have the opportunity to choose from all the assets in the world. Nobody says there's a stock out there and you're not allowed to buy it, okay? Or there's a bond out there and you're not allowed to buy it or something like that. So if we have the opportunity to invest in all the assets in the world, then it's still a hyperbola that is there. Well, let's now start talking about how we view the standard deviation of a portfolio that has more than just two assets in it. We saw before that we came up with a weighted variance covariance matrix, and we came up with the standard deviation of a portfolio that has two assets in it. So let's go back and take a look at that as a quick review, and then we'll start adding more assets to it. So remember that when there was two assets in my portfolio, we'll call them assets A and B again. Here's asset A and B. We have a 2x2 variance covariance matrix. 2x2 meaning two rows and two columns. And in up here where A and A come together, this was the variance of A. Down here where B and B come together, this is the variance of B, right? And here where A and B come together is the covariance between A and B. And here where A and B come together is the covariance between A and B. Now that is a variance covariance matrix. To get a weighted variance covariance matrix, then you have to add the weights. Here where A and A come together, we want the weight in A squared. Here where B and B come together, we want the weight in B squared. Where A and B come together, we want the weight in A times the weight in B. And here where A and B come together, we want the weight in A times the weight in B. Now, what you notice is that these two cells on what we call the diagonal, starting in the upper left hand of the matrix, going down the bottom right hand, are variance cells. All the other cells, which is two in this case, these two are covariance cells. Now, as it turns out, this cell and this cell are twin sisters. They're identical to each other. We've got the weight on A times the weight on B times the covariance between A and B. You got the exact same thing up there because uh, where A and B come together, it doesn't matter whether it's A and B or whether it's B and A. The ordering doesn't matter in the weights and in the listing of a covariance. So we have four cells in the weighted variance covariance matrix. You add those four cells together and you have the variance of the portfolio. Take the square root of that and you have the standard deviation of the portfolio. Two of the cells have variance terms. Two of the cells have covariance terms. Well, what happens if you add a third asset to the portfolio? We'll call it asset C. Well, now you have a weighted variance covariance matrix that is 3x3. So it's going to have three columns and three rows. So it's now going to look like this, okay? 3x3. Down here, remember, everything on the diagonal is variance cells. So this is going to be the variance of C. This is going to be the covariance between A and C. This is going to be C there and C there. This is going to be the covariance between B and C. This is also the covariance between B and C. And this is going to be the covariance between A and C. Now, you're also going to have the weights in there, but I'm going to just save myself and save you the time of me writing all of those things in there, okay? But we can see now that we have three variance cells and 1, 2, 3, 4, 5, 6 covariance cells. What if I add a fourth asset to the portfolio? Asset D. Well, now I've got a 4x4 weighted variance covariance matrix. Here is column D. Here is row D. And guess what? I'm adding one more variance cell. That's the variance of D. And I would put the weights in there as well. Here's going to be the covariance between A and D. Here also is the covariance between A and D. They're twin sisters. Here's the covariance between B and D. Up here is going to be the covariance between B and D. Here's the covariance between C and D, and here's the covariance between C and D. And of course, you would have the weights in there as well. So now of our 16 cells, 1, 2, 3, 4 of them, one for each asset, are variance cells. The other 12 assets, or excuse me, the other 12 cells will be covariance cells. So notice as the portfolio is getting bigger, each time you add an additional asset, we add one variance cell, but we're adding many more covariance cells. Well, what's going to happen as we get a really big portfolio? Let's suppose we have 100 assets. I'm not going to draw this one out here all the way. If I have 100 assets in my portfolio, I've got 100 columns, don't I? And I've got 100 rows. And all of the diagonal cells are going to be variance cells. There will be 100 of them. All of the off diagonal cells will be covariance cells. So if it's 100 by 100, there's going to be 10,000 cells, right? 10,000 cells. Of those 10,000 cells, 100 of them will be variance cells, and 9,900, therefore, will be covariance cells. So you can see as the portfolio gets bigger and bigger, the covariance cells become more and more important. As the portfolio becomes bigger, the number of variance cells are increasing linearly. The number of covariance cells are increasing exponentially. See, if I've got, let's say, n assets in the portfolio, then the number of cells in my matrix is going to be equal to n squared. That's how many cells I'll have. The number of variance cells will be 1 for each asset. So there will be n variance cells. And therefore, the number of covariance cells is going to be n squared minus n, or we can say it's n times n minus 1 there. So we can see that the number of covariance cells is going to be increasing much more quickly than the number of variance cells. And what happens is with a really large portfolio, the variance cells really become insignificant. It's these covariance cells that are most important. And we're going to see that that has great implications for the pricing of assets that are held as part of a large portfolio. Well, what we get with all of this is we get what we had with just 2 assets. We have in mean variance space, expected return, standard deviation, we have a hyperbola. And if I have all the assets, all the risky assets in the world to choose from, they're still all going to fall within this hyperbola. And we still have an efficient frontier, okay, that goes right up along in there, and people are going to choose from those assets. However, there's one asset we've forgotten about. Well, we haven't really forgotten about it. We just haven't included yet. If these are all the risky assets are in here, remember a risky asset is an asset that has a positive standard deviation. The one asset we have left off is the risk-free asset. Remember, our definition of a risk-free asset is an asset that has a standard deviation of 0. Gives us the same return all the time. Now, it's got a positive return. It doesn't have a return of 0, but it's got a standard deviation of 0. So let's draw it right there. That's R sub F. That's how we denote the risk-free asset. There's our risk-free asset. Now, suppose I want to combine the risk-free asset with one of the risky assets. Well, if I want to combine it with this particular risky asset there, if I put some money in the risk-free asset and some money in this risky asset, I can be anywhere I want to be on this line right there. Let's suppose that risky asset is Walmart. Okay, so here's this expected return for Walmart. There's the standard deviation of Walmart. There's Walmart right there. Put some money in the risk-free asset, some money in Walmart. I can be anywhere I want to be on that line. By the way, that's a straight line because the risk-free asset has a covariance of 0 with all other assets, and because the risk-free asset has a standard deviation of 0. If you doubt that the risk-free asset has a covariance of 0 with all other assets, think about it. Covariance, for a positive covariance, the two assets are going up and down together, right? For a negative covariance, they tend to move opposite each other. Well, how does the risk-free asset move? It doesn't move at all. So another asset is going up and down like this, while the risk-free asset doesn't move. They're not moving up and down together. They're not moving down opposite each other. There is no correlation between the two. Okay, so with a 0 correlation or covariance between the risk-free asset and a risky asset, we've got this straight line. You can be anywhere you want to be on this straight line. If you put all your money in Walmart, you're right here. You put all your money in the risk-free asset, you're right there. You put half your money in each of them, you're going to be right there in the middle somewhere. 80% in Walmart, you're going to be right there. 80% in the risk-free asset, you're going to be right there. Well, you know what? We can do better than Walmart. Let's suppose we want to go up here, and maybe this is Microsoft up there. And I can combine Microsoft with the risk-free asset. Now I can be anywhere I want to be on this line that starts at the risk-free asset and goes up to Microsoft. Put all my money in Microsoft, I'm here. I put half my money in Microsoft, half in the risk-free asset, I'm right here. Put all my money in the risk-free asset, I'm right there. Now, this line, okay, that it's called a capital allocation line, by the way. This line from Microsoft to the risk-free asset dominates the line for Walmart with the risk-free asset, because no matter where you are on this line, you can do better by being somewhere on this line. You can get a higher expected return and a lower standard deviation. And as risk-averse investors, we all want higher expected returns and lower standard deviations. My gosh, that's like getting more Boston cream pie with less Brussels sprouts. Who could ask for more than that? So at any rate, we would rather be, this one line dominates this line. Well, you know what? We can get another asset that dominates the one with Microsoft. Maybe we can go over and find, let's say General Motors maybe is over here, okay? So you put some of your money in General Motors and some of your money in the risk-free asset. You can be anywhere on that line, and that dominates the Microsoft line. Well, which risky asset dominates all of them? Well, I'm about running, it's kind of getting messy over there. So here is my hyperbola. Here is my risk-free asset. This particular risky asset or combination of risky assets is going to dominate all of them, because this line right there is just tangent to the hyperbola. And so if I put some of my, and we're going to call this a portfolio of risky assets, we'll call it portfolio M. So if I put all my money in M, I'm right here. If I put all my money in the risk-free asset, I'm down here. I put some of my money in M, some of my money in the risk-free asset, I'm going to be down here. I can also get up here. I haven't shown you how yet, but we can also get up here through what we call leveraging. Okay, we'll talk about that in a future video. But at any rate, I can be anywhere I want to be on this line there. Now, nobody wants to be here because you're dominated if you're up here. Nobody wants to be here. You're dominated if you're up there. Nobody wants to be there. Nobody wants to be anywhere inside this portfolio. Everybody wants to be on this line. By the way, that line has a name. It's called the capital market line, the capital market line. And the reason why it's called the capital market line is because portfolio M, if you've read the chapter, you know this, portfolio M is the market portfolio. That it can be proven, okay, that if you put your money in the market portfolio, that market portfolio is going to be just tangent to this line that goes from the risk-free asset up to the market portfolio and up there, that line is going to be tangent to the hyperbola. That means by combining the market portfolio with the risk-free asset, everybody is going to agree that is the best combination of the with the risk-free asset. Here we saw we saw you could combine Walmart with the risk-free asset, and everybody likes Microsoft with the risk-free asset better. Everybody likes General Motors with the risk-free asset even better than that. Well, everybody is going to like the market portfolio with the risk-free asset better than any of them, better than any possible other combination. So the way it appears here right now is that everybody is going to invest in the market portfolio so that they can be somewhere on this capital market line. Now, where will they go on that capital market line? That's up to each individual investor. It depends on how risk averse you are. My mother-in-law, she's going to go way down here with all her money in the risk-free asset. Okay. You might be somewhere in here. I might be somewhere up here. The further we go up here, the more expected return we're getting, but we're also taking on more standard deviation. Now, remember, our definition of a risk-averse investor is not that they always want the lowest standard deviation. It's that they must be compensated for taking on more standard deviations, compensated with more expected return. So as we move up the capital market line, yes, we're taking on more standard deviation, but yes, we're also being compensated with more expected return. So some risk-averse investors will go up here, some will go down here, some will go down there. Now, what we haven't yet addressed is exactly how you get up here. Okay, we'll do that in a little bit. But let me first of all mention what is the market portfolio. The market portfolio is going to be a combination of every risky asset in the world. Every risky asset in the world. You've got some of all the risky assets, means some of every single stock that's out there, every single bond that is out there, every single piece of real estate, every commodity, every precious metal, all of it. Okay. And according to this, that's what everybody's investing in. I bet you're investing in that, right? No, I'm sure you're not. I'm not. Nobody is, because nobody can put their money in something of everything. Not only that, but it's not just some of your money in every single risky asset. It's in specific proportions. It's what we call a market weighted average of everything. Let me show you what I mean by that. Let's suppose we took the arduous task of listing every single risky asset in the world. So let's go and in order from the one that's got the highest market capitalization to the one that's got the lowest market capitalization. So let's suppose that Amazon, okay, and these things change around depending upon when you're watching this video, but let's suppose that Amazon has the highest market capitalization. And let's just say it's $2 trillion is its market capitalization. And let's say Apple is second, okay? And let's say that's $1.5 trillion. And let's say that Microsoft is third at $1 trillion. And we can go on down there, okay? We can list all the risky assets in the world, right? And that's all the stocks, all the bonds, all the real estate, everything. And the smallest risky asset in the world is Joe's Diner. Joe's Diner has come on hard times. It only has a value of $200. You can buy the whole Joe's Diner for just $200. Well, we take the market capitalization, again, which is the price per share times the number of shares outstanding. In other words, what would it cost to buy the whole thing, okay, for every risky asset? And we sum them all together. We add them all together here, okay? And that's what it would cost to buy every risky asset in the world. Now, a market weighted portfolio, or a market cap weighted portfolio, means that the proportion of your money invested in Amazon is going to be this number divided by this number. The proportion of your money invested into Apple is going to be this number divided by this number. The proportion of your money invested in Microsoft is going to be this number divided by this number. And that would be true for every single risky asset, even Joe's Diner. The proportion of your money invested in Joe's Diner is going to be this number divided by this number. It's a very, very small proportion, but that is what the market portfolio is. The market portfolio is sum of absolutely everything, specifically in these proportions. Well, nobody can do that. You can't even just get some of everything out there, okay, into a portfolio, but to have it exactly in the market in those proportion, it can't be done. So therefore, we don't let that stop us in finance, by the way. Therefore, what we need to do is we need to come up with a proxy for the market portfolio. We need to say, hey, if we can't actually put together this market portfolio, what can we put together to run some tests on that's as close as possible to the market portfolio? Now, it needs to have a couple qualities. Number one is it needs to be tractable. It needs to be something that we can look back and see what was the return on this portfolio last week, last year, 5 years ago, 10 years ago, so we can kind of, see what's happening with it and run some tests on it. Also, it needs to be a pretty big size portfolio, and probably just as important, okay, is it needs to have a weighting system that's not too terribly different from the weighting system in the market portfolio. Well, as you're probably aware, we do have such a proxy for the market portfolio, and it's called the S&P 500. The S&P 500 is 500 large cap stocks that are all U.S. stocks. There's no international stocks there. A lot of people think that it is the 500 largest stocks. That's not true. There is a committee at Standard & Poor's, which is a subsidiary of McGraw-Hill, who publish your textbook, by the way. But there's a committee at Standard & Poor's who decide which stocks will be in the S&P 500, and every few weeks they'll kick one or two out. They'll bring another two in. They're trying to get a broad representation of the U.S. economy. But anyway, there's 500 stocks there. The weighting system is exactly like what we saw here. There's Amazon is in it, Apple's in it, Microsoft, and so Joe's Diner, unfortunately, is not part of the S&P 500. But we take our 500 stocks, okay, which I want to emphasize, it's only U.S. stocks, and it's not necessarily the 500 with the largest market cap, okay? They don't do that, but it's going to be mostly large cap stocks, and you do the exact same weighting system. They say, for the 500 stocks, they total their market value, and they say, okay, this divided by this is the proportion that goes in Amazon. This divided by this is the portion that goes in Apple, et cetera, all the way through there. So the S&P 500 is not the market portfolio. It is a proxy for the market portfolio. It is a stunt double. It's a stand-in. It is a substitute for the market portfolio. So we can run tests on it because we know exactly where the S&P 500 has been and what it has done for decades. So that's very helpful for us. And so we're going to say, hey, this is a reasonably close estimation of the market portfolio here. And we also need a proxy for the risk-free asset, which we talked about earlier. And typically, we'll use something like the 3-month Treasury bill, which does not have a standard deviation of 0, but it's close to it. Or we may use the 1-year Treasury bill, or some people even use the 10-year Treasury note as their proxy for the risk-free asset. So we can kind of run tests on this. Well, we'll talk more about this in our next video. But very importantly, what we're going to have to talk about is leveraging, because that's how you get up here. See, this is all your money in the risk-free asset. This is half your money in the risk-free asset. This is all your money in the market portfolio. Well, how do you get up here if this is all the money in the risk-free asset? This is all the money in the market portfolio. Well, that's what we'll see in the video on leveraging.